Good morning, good afternoon, good evening, whenever you are watching this week's video. Hey, I'm back. Whole different day, different outfit. But when you see this split, you're going to be like, what? Is she doing a transition like in a video? No, she's not. What happened was originally I recorded the whole passive activity and at risk rules in one sweep. That's how I do most of my videos. But I had to go to the team and say, y'all, this long. Should we chop and screw this thing, and where should we chop and screw it? You'll hear me talk about it in the video at the end. Did I go ask them? I did, and they agreed. Baby, chop and screw this video. So we are picking up on part 2 where we left off last week, where I go into a little bit more detail. Now, everything still is an overview. You're going to hear this. Everything is an overview, and we still going to break stuff down in more detail about the 7 tests and everything that you heard last week, especially about basis, because y'all going to continue to ask me that question. But for now, I want you to just keep going. And if you have not watched part 1, go back, watch part 1, then watch part 2, and then let me know what questions you have so that we make sure that these videos that we are doing and showing into your mailbox actually give you the answers that you need and a starting foundation for you to continue to build from. Go ahead and watch. Let me know. And besides the hair looking different and the outfit looking different, let me know what your questions are. All right. This is how you group your activities. You may treat one or more trade or business or rental activities. And so this is why I want y'all to see right here where we stressing or business or rental activities. It ain't got to be all. So some people, even when you running your Schedule C activities, your regular business, so in my case, an accounting and tax practice, right? That's a trade or business. It ain't necessarily rental activities. Now, I do have that, but those are two different distinct activities. But in this one, you can treat one or more as a single activity. How I leverage this in if they form an appropriate economic unit. So instead of looking at, let's say you own 5 rental properties, instead of looking at each rental property and being like, oh, in order to qualify, I have to have worked 750 hours on each property. What will happen is that collective unit of all those properties amongst the 5, are we able to get to that 750 hours? Because you may have one that kind of is self-sustaining, and then you got to put a lot more time at the others because it just happens to be like that. Also, keep in mind that there may be a year that you qualify to be a real estate professional, and then there may be a year that follows after that where you don't qualify to be a real estate professional just because you didn't have the hours or you're not doing those real estate necessarily activities. I have actually had that happen where, because I do have rental property, where we had a year where we would qualify real estate professional, and then a year where we didn't because we didn't have enough hours. Even with my husband being in construction services, depending on what his construction services and activities were related to, that would determine whether or not we would be able to file like that in that year. So there's times I'm like, okay, yeah, we qualified. And there's times it's like, nah, we ain't got enough. We don't qualify. And then sometimes there's been times where, because of where we land, right, we got our passive activity loss. All of it depends on what's going on for you during that year. Appropriate economic unit factors: similarities in type of business, common control and ownership, geographic location, interdependencies, shared customers, employees, books. And so now, I don't want y'all to think this is just for real estate. Notice we said trade or business. So a lot of times when I'm talking to clients and we're talking about stuff, I'm like, well, let's group this business activity together, these business activities together. This is why I was like, don't do a hodgepodge LLC. Let's like group all the business activities like to like. So that is separate and distinct, and we can figure out how we're going to follow these rules to determine, number one, is it really a hobby? Is it a trade or business? And if it is a trade or business, do we have enough hours? And if we got any losses, can we leverage that loss against that? If you have W-2 earnings or any other active income, non-passive income, can we offset it? I'm going to say that again. We have to group activities like with like, then determine when we create these business entities, putting them all under the same umbrella. Then after we're doing that and putting them all under the same umbrella, we are determining if that business happens to have a loss for that year, how much of that loss are we able to leverage in the current year against non-passive activity or non-passive income to lower where we end up on our tax bracket. Because sometimes we can't do it, and sometimes we have to hold it and carry it forward and leverage it. That would be your net operating loss. Doesn't go away. We just can't use it at this time. Activities that cannot be grouped. Trading activities, and this is for effective calendar year 2022 and forward. So that's in the stock market, you out here trading. Limited partner entrepreneur interest in films, farming, leasing, oil and gas, geothermal. They can't be grouped with other business types. They got to be their separate business, okay? PTP activities, pass-through activities cannot be grouped with any other activity. Regrouping due to net investment income tax. If subject to the net investment income tax, for the first time, a one-time fresh start regrouping election is available on an original or amended return, subject to specific eligibility. So let's say you didn't make the election, you got a time to fix it. Okay? All right. Whew, the girl been talking today. And it's just the overview. Recharacterization of passive income and dispositions. So, when passive income is recharacterized as non-passive, now we made it like ordinary income. Significant participation of passive activities, rental of non-depreciable property, less than 30% of unadjusted basis subject to depreciation, rental of property to a non-passive activity, licensing of intangible property by pass-through entities, right? Disposition of passive activities, passive losses, suspended passive losses are generally allowed in full when you get rid of the business. Get rid of the entire interest. AKA, you sell the property, you weren't able to leverage them passive activities or them losses, you get to recognize them when you sell it in a taxable transaction to an unrelated property. Unused losses increase the transferee's basis. And then somebody told me I need to teach basis. Death, losses allowed only to the extent that they exceed the step-up in basis. And installment sales, losses allowed proportionally as gain is recognized. And y'all probably like, Patrice, you reading the slide. So what does that mean? You're not losing the passive activity losses. That's what it means. Those things can build up and build up and build up. And I have clients that it is building up and building up and building up. And we recognize them when we sell the property for real estate. Or when the business is closed and it's no longer in activity, this is what we're doing. But you got to give up your entire interest to recognize your portion of the loss so that it can offset ordinary income. It's not like you're trying to be like, okay, this is what's happening, and I'm going to, what's it called? And I call myself getting over, and I'm using it like as bankruptcy or something like that. This is not that. What's happening is, hey, I no longer want to be a landlord of any sort. Even though I got a property management company holding it, boom, I don't want no parts of this. So I'm selling this, and it's not in a like-kind exchange. I've given up my entire interest in this property, but I got some losses built into here. Those losses will be able to be leveraged to offset any gains, any depreciation recapture, etc. But and we get to recognize those losses in full at that time. That's what I'm saying. Ask at-risk rules. The at-risk rule limit losses to your amount of risk, your portion in any activity. You apply these rules before the passive activity loss and use Form 6198. This is where basis is coming in. Activities in this section include motion picture films, videotapes, farming, leasing, property, oil, gas, all this other stuff, right? So the reason why you say that is because a lot of times with filming, they got all these expenses, everything, before they ever recoup any profits or see any revenue off of this. And then if they coming up to a loss, it's up to their limit. Same thing with, sometimes it can be that way with farming, because depending on if they backed by USDA and have all these things, it may take a while before they see any revenue really generating or show a profit, right? Where they don't have these losses in farming activities, which is actually a good thing to look into, right? And then the same thing with oil and gas. But a lot of times I see with people with oil and gas, most of the oil and gas that I have seen is on K1s. They coming through partnerships and they are getting their K1 and saying, okay, this is your distribution for the year. This is your profit. This is your portion for the year. This is your loss for the year. And it's up to their risk or their at-risk rules is limited to their portion that they contributed, not the full amount of like the whole fund, if that makes sense. All right. Let's go back because there is something that talks about recapture on here. And recapture, we do that with depreciation and got to talk about that later. If your at-risk amount drops below zero at year end, you must recapture previously allowed losses, adding to income the lesser of the negative at-risk amount or total prior loss deducted. Meaning, Patrice got to break this down and give you more examples so you can be like, what exactly the heck do this mean? Why was my phone that loud? What the heck does this mean, and how does that apply to me in the situation? Okay. Oops. I switched pages. All right. So now what's new for 2025? Research and development. Okay. How those expenses are going to be handled. We already talked about R&D. Why do we say research and experimental expenditures? Same thing under R&D. That's coming up for domestic R&E deductions under the One Big Beautiful Bill. Okay, so that started in 2025. It allows taxpayers to deduct domestic research and experimental expenditures in tax years beginning after 2024. So 2025 and forward. And then what happens is they can elect to amortize over 60 months. That's the part that's most important. Those activities. And those can be listed as a trade or business. Section 1245, property expanded as the qualified production property. So we had a conversation about this. Also, those manufacturing locations, because y'all know they're getting a lot of incentive. The more and more it starts to fall out. Y'all see why it was built into the tax code, into the One Big Beautiful Bill. Property placed in service after July 4th, 2025. And what's the significance about July 4th, 2025? That is when the One Big Beautiful Bill was signed. But before 2031, with construction beginning after January 19, 2025. Okay, so pretty much you building a qualified production property, right, falls within the timeline of this administration. I'm so glad my face not up here. Excess business loss limitation. Non-corporate taxpayers with allowable business losses after applying basis, which I need to go back and explain what basis is. At risk and passive loss limitation. So you got to go down. Okay, so do I still got my basis? Okay, was my portion at risk? Do I still have a balance? Is my passive loss going to kick in, right? Anything excess to that, you get to now complete Form 461 to determine if you have any excess business losses that can apply to you. And this limitation applies after all other loss rules even exist. You mean I can lower some stuff down, but I got to go through this tree process? Yeah, that's what I mean. Check this. Key forms and how to get help. The primary forms that we talked about, the main one I normally deal with is Form 8582. That's the passive activity loss form. I mentioned that. Form 6198. I haven't worked with a lot of these, but that's a form that we can deal with. Limitation on business losses, that's Form 461. And then Form 8582, credit passive activity credit limitations. How do you get more information? There's my favorite kind of tools, interactive tax assistant. I love an interactive tax assistant because it is talking back to us and it can work as that tax professional. So once you answer the questions and put in information to see what category you fall in, and then figure out which forms apply, or even if you can get that deduction or not. So I love that. IRS.gov free file. We'll have some of these, and some, depending on the level that you fall into, you may not be able to file that tax return for free, but it does not hurt to see. VITA is a tool. TCEs, free help for taxpayers for our seniors. And then we got, you always go to IRS.gov. If you don't have an IRS.gov account, why don't we got one? Okay. And then taxpayer advocate service, they step in. The crazy part is the taxpayer advocate service is part of the IRS, but they sit outside the IRS. And so when we can't get realms and get stuff fixed within the IRS, they are our last hope, the taxpayer advocate service. And I have them as well. So we can always go there to get information. Now, sometimes, you know that things are changing and AI is in almost some of everything. Sometimes you'll have somebody who's knowledgeable. Sometimes you won't have people that are knowledgeable. Why am I telling you this? It's because if you call and you ask and you're on a hotline, right? You're on that 1-800 line. The IRS actually got people working these call lines that were in IT and HR. Article is out there. They had to be detailed because they working over there because they got rid of a bunch of people. And so you got to have people working on the backlog. You got people answering phones who may have limited training in these areas because they get like a month and a half. I'm going by article, not something I think. I'm going by article that I read. And I've never worked in the IRS, okay? The stuff I know is years and years and years and years of training. I did VITA when I was in college. I've been preparing taxes for 20-some years. And there's still stuff that I got to be like, what do the publications say? And y'all know I take continuing education. So keep that in mind that you're like, I'm calling these people and what? And they've had limited amount of training. This is why it's important for us to make sure you know where to go find this publication. And it's going to be imperative for us to break down things even further for you. I know this was a long introduction, but I've been being asked this question for a while about real estate specifically, but because you're looking at it and we're talking about passive activity versus non-passive activity and how do you handle losses and how stuff moves forward, I felt like it needs its own breakdown. And most of my clients are asking, well, how do I qualify to be a real estate professional? So essentially, now I'm not just materially participating, I'm actively participating, and I qualify to be able to leverage what's in the code. The biggest thing I wanted to stress was, at all times, real estate is passive. I don't care who you are. Real estate is a passive activity. We set it, we buy it. Yes, we might actively manage it ourselves, or we may hire somebody to actively manage it. But we have to be mindful that we get the real estate, it sits there, it costs us, we get people in the house, we got to deal with repairs, etc. But it's a passive activity, just like when we are, even though it don't feel like it. Day trading is more active, right? It's more ordinary income. But it's like when we put money and we invest it for the long haul, and then as it grows, then we take it. That's passive compound interest, right? So keep that in mind, that what this is versus what it's not, and why you have to start with, okay, am I materially involved? Am I actively involved? Do I qualify to be a real estate professional? Do I pass these tests? And we'll go into those in more detail. Okay? Hopefully this makes sense. It's hot in here. I need to go get some water because I'm parched. But I'm glowy. 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 At least my face routine working. For now. Till it gets to be too hot. And I'm going to have to be walking around here with a fan. Just because I'm at that age. And it's hot outside. Until next week. Where I go through and talk about the 7 tests. And then in the following week when we wrap. No, next week is the wrap up. The week after that is the month because I done held out on y'all for 1 week. I'll talk about the 7 tests and we'll talk about the 750-hour rule plus the 500-hour rule. And then I have to think of one more way to present this information so it'll answer the questions that clients have been asking me so that we can summarize it better. Thank you for sticking to the end. I know it's long, y'all. Maybe we'll chop and screw this. Kind of give you a part 1 and a part 2 in the same week. Who knows? I'm sure my team will tell me, Patrice, do it like this. And it will do what we need to do. All right? Until next week, I'm going to holler at y'all. Peace.